Welcome to the Real Estate Investing Failures to Fortunes podcast, the show where we fearlessly dive into the untold stories of real estate investors' greatest setbacks and how they turned those failures into resounding successes. I'm your host, Kate Berry, and we're talking with real estate investors across the country to learn exactly how and why they failed, and how they took that failure and turned it into a powerful lesson for their business. So come along with me, Kate Berry, on this transformative journey from failure to fortune. I invite you to join our supportive community where together we can inspire, educate, and motivate each other to achieve all of our real estate investing goals. Welcome to the Real Estate Investing Failures to Fortunes podcast, the show where we fearlessly dive into the untold stories of real estate investors, greatest setbacks, and how they turn those failures into resounding successes. I'm your host, Kate Berry, and we are talking today with Julian Vogel. He is the fund manager of Colony Hills Capital and here to talk to us about syndications, getting into some really exciting multifamily deals. So we're really excited to have you, Julian. Thank you so much for joining us today.
Thanks for having me, Kate. Excited to be here.
Good. I'm so excited. Let's get right into it. So tell us a little bit about yourself, how you got started in real estate, and share a bit about your background.
Sure. So I sort of fell into real estate. My first job out of college, I worked for a family office that was based in Eastchester in the Bronx. And I was mentored by the head of that family office on how to, first of all, sell real estate, broker, real estate transactions, but also how to facilitate the debt, the mortgages for commercial real estate transactions. And he's a guy who had 35 years experience at the time. And I was basically his apprentice for a year and a half before I went to work for a top 15 commercial mortgage brokerage called Deerwood Capital. And I was there for a couple of years and I worked on probably $500 million worth of transactions. And then I left, started my own firm for 3 years, doing the same thing just by myself. Got married. By the time I had my second kid, moved back to Western Massachusetts, where I'm sitting right now.
Awesome.
And I hooked up with Colony Hills Capital, and that was this summer will be 5 years ago.
Amazing.
So
that's great.
Yeah, that's my background.
And when you started, what year was it? What was your market like when you first got into this?
Yeah, that's a good question. I started in 2011. So yeah, 2011 was when 2012, 2011 is when I started. And the industry was just coming out of the '08 crisis. And there was people who either lost a lot of money or made a lot of money. It depended on what side of the fence they were on, right? Because there was a lot of real estate investors who were able to buy quality pieces of real estate for 25 cents on the dollar and then turn around and sell those same assets or refinance those same assets in 2011, 2012 and make amazing amounts of money.
And unfortunately, a mentor who had been through 35 years. So I'm sure he had seen it all, really.
Oh, yeah.
What a great person to learn from.
Yeah, big time, big time. And then the next company I worked at as well, the camaraderie was phenomenal. There was 15 brokers headed by 2 partners, and the company was doing $2 billion a year in transactions. We were all sharing our deals, sharing the details of how we capitalized those deals, what the deal scenarios were, was being introduced to lenders, equity partners, et cetera. A lot of good experience there as well.
Can I ask, what gave you the bug in real estate? What was it that got you interested in it, wanting to make a career out of it?
I think I loved the hunt. I loved the process of finding a good transaction. And then I also love the process of selling that transaction to investors and raising the capital around it. I'm not very good at selling something I don't believe in. So I have to really believe in what I'm selling to be successful. So I'd say that two-pronged process. First of all, finding the deal, understanding it, but then orchestrating the right capital for it and closing it. It's a lot of fun. Yeah.
It is fun. When it's good, it's really fun, right?
It is. Yeah. Yeah. Definitely.
And yeah, 2011, a lot of people were afraid of real estate. People are still afraid of real estate today.
Yeah.
And so you jumped in at a time where everyone else was afraid, but I mean, sounds like you were seeing people make some serious money during that time.
Oh yeah. The one example I can think of was this one of my first clients at the time. I don't have clients anymore. I should say as a fund manager, I'm working directly for Colony Hills Capital and I structure all of the debt and equity for their deals and also for the funds. But my first client as a commercial mortgage broker was an individual who had worked in sales, had a nice windfall in his sales position. He was selling computers to Pixar. And then he used the money he had made from sales, and he bought a portfolio of real estate in Houston. Like I said, 25 cents in the dollar, right? And he managed those deals himself. He renovated them, those deals himself. And then when I connected with him 3 or 4 years later, it was for a refinance. And he was literally, his equity had multiplied by 4 times.
Wow,
So that was a pretty cool story.
that's
But that's
awesome.
the power of real estate. I mean, that's the power of timing as well, knowing when to
Yes,
get a deal in the market, et cetera. So,
that's right. It's so true. I heard a great quote the other day. It said, "Don't wait to buy real estate, but buy real estate and wait." I
mhm.
think, I mean, anyone I've ever talked to, and for my clients, when I ask them, "Do you regret what you bought 10 years ago?" I mean, if real estate just takes some time
Yep,
to do its thing.
to
Um,
appreciate. Yeah.
so, but if you can get in when everyone else is afraid, or if you can find the thing that's hard to do and become very good at it, there is a lot of upside.
Absolutely. Speaking of timing, I think this year, 2024, is a fantastic time to be buying. And you made a good point that most people are afraid or bewildered or confused, not really knowing what to do with their money, not knowing whether they should get into real estate or not. There's a lot of quality pieces of real estate out there, both in residential and commercial, who
Mhm.
have had valuations go down because interest rates have gone up. But the reality is if you could buy those deals at a discounted valuation because of interest rates and then wait a few years for interest rates to come back down and valuations to go back up and
Right.
then sell, you're going to be in a pretty sweet spot. So I think right now is actually the perfect time not to hold back and not to wait. Right now is actually the best time to be investing.
I absolutely agree with you. And our podcast is from failures to fortunes. So I'd love to deep dive a little bit into your story, your history. Tell us about how you got to where you are today.
Sure. So I'll focus on my time spent with Colony Hills Capital because that's the most recent sort of challenge and pivot to a success. So Colony Hills, we're totally focused on the acquisition and repositioning of what's called garden style multifamily real estate. So it's these sprawling communities that are 2 to 3 stories, usually have their own entrance, exit, clubhouse in the center with a pool. Maybe you've lived at one, maybe people live at one. There's dozens of them in most cities, right? More than dozens, right? So that's what we focus on. And within that space, we focus on B to A minus. So we look at deals that are 20 years old. Basically, anything that's 2000 or late 90s, early 2000s, that's where we hang out. And these are properties that are 250 to 500 units,
Yeah.
and the deal sizes range from 30 million to 100 plus million. And that's what we've done. That's what Colony has done since 2008, really. So
Great.
totally focused on just that segment of the
Yeah,
real
I love
estate
that you
world.
have a specific buy box. I feel like
Yeah,
that's so great, especially for anyone listening to this. How do I get invested started in real estate? There's so many ways you can get into real estate. And I think by becoming specialized and understanding your market and your clients, your buyers, your sellers, that's how you're going to be able to really get into a groove. And I love hearing when you have a specific what you're looking for, because then when it makes sense, right?
yeah, absolutely. And then you can become, instead of being a jack of all trades, master of none, you can be a professional in one segment and more efficient. And also, in our opinion, my opinion, that segment of alternatives and that segment of real estate is the most resilient and most secure type of asset because housing is always needed. And the middle market housing, that what I just described, that sort of 2000 vintage B minus to A minus,
Yeah.
it services the largest percentage of tenants, right? That mid-market housing represents the largest need in the country. So that's
Right.
why we like it.
Buyers or tenants, you're able to, really have, I'm sure, very low vacancies.
Yes. Yeah, that's right. About 5% to 8% average vacancies, which is very strong.
It's very strong.
So as far as as far as you said, fortunes to failures, right? That's the theme. From 2020 to 2022, midway through 2022, we and most owner operators in our segment of real estate were using bridge financing, which is short-term debt that's
Right.
floating rate and it's high leverage, and valuations were peaked, and that's how we got deals done. We did a ton of volume, but rates were at like 3 to 4%. But floating. We bought rate caps, which means we purchased a ceiling for those interest rates, for the floating rate interest rates. And what happened is, I remember it like it was yesterday, in April 2022, all of a sudden rates started to skyrocket. And that obviously impacted the portfolio we had purchased between 2020 and 2021 with that floating rate debt, right? All of a sudden, that whole portfolio was stressed because of the new,
It happened fast too, and it
fast.
to a level that was the rate itself. Everyone says, okay, 6-7% is normal. But when you raise it from 3 to 6 in a matter of 3 months, that it creates this aftershock effect in the real estate market.
Yeah, exactly. That's spot on. And I think that was the main critique a lot of specialists or people with opinions in the industry had against the feds. Maybe doing it in more of easing the country and the economy into it as opposed to doing it overnight probably would have been more reasonable, but it is what it is.
They
now.
had their mindset. They said,
Yeah,
we will not stop.
yeah, exactly. Not really concerned about the collateral damage of that movement, but anyways,
That affected you obviously very severely.
Us and most of the real estate industry, honestly, and I know of plenty. Thankfully, we had cash and liquidity to help support those assets, but there's a lot of groups like us who floundered and who are on the verge of losing their portfolios and losing their investors' equity. So the pivot that came from that happening shortly after April 2022, when we were looking at new acquisitions, we made up our minds that we're only using fixed rate interest rates, modest leverage, meaning for those out there who aren't familiar with the term leverage or what I'm referring to, I'll give the example of buying a house, right? You buy a house for, let's just say 100K, just to use an easy number, and you're going to use 70% loan to purchase, right? That's 70,000 right out of the 100. So at the time we'd have a renovation budget, we have closing costs. So to use that same example, let's say it was 100K, but you add in all the renovation budget and closing costs is more like 120. So out of that 120, we would use leverage that would cover 75% of that 120. When you compare that to the actual purchase price, though, it's very high leverage. So what we decided to start doing is only using loans that are fixed interest rate, tied only to the purchase price, not to the closing cost and the renovation budgets, and use 55 to 65% leverage. So more modest leverage. And then the other piece that we focused on is neutral to positive leverage. What that means is there's a term called a cap rate. Some of your listeners might know what that is, some might not. A cap rate is simply taking the net operating income of the property and dividing it by the purchase price. And that gives you a sense of what the yield is for that investment. What am I going to make off of my investment on this deal? It just kind of gives you a gauge of the health of the asset and also the value.
They're going to come back to you. How is your money going to work for you in this specific deal?
Right, exactly. So the term neutral leverage means that the interest rate that you're using to buy that property is equal to your cap rate. It means that you are, from your cap rate, you're earning the same yield that your lender is earning. And it
Interesting.
gives you a good sense of how tight is this opportunity? How, like, it's just another layer or gauge of, by the way, apologies for any listeners. There is work being done in my house, so I don't
Oh,
know if
that's
you
all
guys
right.
can
No,
hear that.
good.
Okay, good. So what you ideally want to see is you want to see either neutral or even positive leverage. Positive leverage means that your cap rate is meaningfully higher than the interest rate that you're borrowing for, so that you have solid buffer as far as yields. The property's throwing off a healthy amount of cash flow. You're easily paying your debt service. So that's a really good gauge for the opportunity. So what we started to do is we only look at, for our new deals, we only look for positive leverage. So we want to be buying cap rates on deals that are north of our interest rate by at least 50 basis points. So that means if we could borrow at 5.5%, we want to be buying a cap rate at 6%.
Right.
And then to boot, these are value add deals. So we're buying good cash flow, but we can also increase the cash flow by doing renovations, increasing the rents, marking the rents to market, right, to what everyone else in that market is charging for the same sort of housing, reducing expenses wherever we can. And then we look to sell after 3 to 5 years. So after we've done all that work, then we look to sell. So to summarize, the pivot that we made was modest fixed leverage and neutral to positive leverage from a cap rate perspective. And that's served us very well. The last 3 deals that we've done and a deal we have under contract right now have been very healthy, conservative investments versus the
Hey,
2020, 2021 track record. So
yeah, it sounds like it makes absolute sense, right? If you're going to have a cap rate of say 10% and your interest is 6, you're
your
basically
spread.
saying you have now a buffer, right?
Mhm.
Especially should the market, should valuations go back down, should interest rates go back up, it's okay because you're at a fixed rate. You don't have to
Mhm.
worry about that changing. Has it been difficult to pivot that pitch to investors?
No, I mean, investors want to see that anyways. That we made that pivot, and then we came to find out that everyone else did also.
That's
In
good.
in our space, all the institutional investors who usually do joint ventures with, they want to see the same thing that we were pivoting to anyways. So that was a good shift.
Yes, it felt like in 2020 to 2022, I mean, everybody got into real estate at that same time because it seemed probably very similar to 2008. Seemed great, and there was no end in sight, and we're just going to see 20% appreciation, year. So we saw in our market, especially in southern Vermont, and you might probably saw it in Western Mass too. I think the pandemic was a price market corrector in many senses. We were so undervalued, especially compared to the rest of the country. But then what we have is the rental market also exploded, which we had never really seen before. And although we've seen how property values and appreciation start to level out, we've seen still the same high levels of rent coming in. Have you experienced something similar in what you're doing?
Yeah, so I would say it's really market specific in the country. There's some markets where rents have cooled and are even coming down some, and then there's other markets where they're still going up. As an example, one market where we just had a deal under contract and we walked from the opportunity just because the property condition report came back and it was a horror show. But we like the market anyways. It's Knoxville, Tennessee. There's
Really?
growth there. There's still rental growth there, right? Because there's spillover from Nashville into Knoxville. Where there's cooling right now, rents, as an example, would be like Houston, Texas, where it just got totally overbuilt. And
Right.
now there's a surplus of housing. But then there's markets where, like a market we like right now is South New Jersey, like Princeton or Mount Laurel, those sorts of areas, where it's more difficult to build, and so there's still a supply constraint and there's still growth. There's people moving there and the economy is strong. So it's really market specific, but I think you guys you in particular, you probably benefited from COVID because of the birth of remote working and
Yeah.
people leaving the cities and being able to live wherever they want, right? And still have the same job. I know 2 summers ago, I was in Sun Valley, Idaho at a Walker and Dunlop conference. This beautiful place, absolutely beautiful. And they had a concert as one of the night events. And one of the locals, a lot of the locals came to the concert, and I was standing in line for a drink, and there was an elderly guy standing in front of me, and I started chatting with him. And he told me that in the last year and a half, his house had quadrupled in value because Sun Valley and the surrounding area all of a sudden was a known entity. And that happened in many sleepy markets, right? Where people all of a sudden discovered it. And one of the silver linings, I would say, of COVID.
Yes, it's been really quite remarkable, and we have not seen the demand or want for people to live in our market go down. At the same time, our local economy we don't have jobs coming in necessarily. We don't have Amazon or big tech. We had a few high-paying jobs at local nuclear power plant, but that got shut down a couple of years ago. So the ability for population growth to happen with increasing median incomes without needing a big job supplier to come in has really changed the game.
Totally.
And I think the game just totally changed. 2020, the pandemic changed so many markets, and it changed the whole game of real estate, and it changed it very quickly. It sounds like you guys were able to adapt. You mentioned that you had cash reserves, but was there other assets or experience that you think helped keep you guys afloat and helped you be able to pivot and see what needed to be done?
And not other assets, but a lot of, this is a credit to our team and to our leadership at our company, but a lot of brainstorming and think tanking to problem solve. There's a lot of IQ that was going behind every decision to make sure that there was no mistakes. So that's gotten us through that tough time.
That's an asset.
So
Brain power.
yeah, think power, yeah, big time. Yeah.
It sounds like you've got an excellent team. It sounds like you really like what you're doing. How do you feel about the current market? I mean, you said 2024 is where it's at. Where do you see it going from here?
I know a lot of people speculate. I don't know, to be honest with you. As the last few years there's so many curveballs and left turns globally and in the country that have taken place. So I really don't know. And I think a lot of the market and investors and people are probably feeling the same way. I don't mean to project on everyone, but I think there's a lot of confusion in the market and not really sure what's around the corner just because of all the things that have happened. Pandemic, war, political,
Yes.
sorry?
I say maybe being flexible, maybe being able to pivot is new strategy, really.
I think the most important thing is to remember that nothing's new under the sun, and that the media and news does a really good job of creating fear, I think. And yeah, and just keep going forward. And in the topic of real estate, it's not going anywhere. Everyone's always going to need a roof over their head, and just find good deals and good opportunities and pull the trigger. And markets are cyclical and all that stuff. So
I'd love to learn more about what your job is as a fund manager. It's obviously a field in this real estate career that you can get into. So tell us, what is your day to day? What is it that you do, and why do you like it?
Sure. So we have discretionary funds. We're on our third one. So when I was initially hired, I was brought on to launch a fund for the company, to launch a discretionary fund, which basically makes it easier for the company to acquire new deals, as opposed to have that pot of capital sitting there, as opposed to on every single deal having to go out and raise the capital. So that was one part of my job, to basically raise the capital for those funds and determine the strategies. But on the second part of my job is on a deal by deal basis. I am responsible for sourcing the acquisition financing, so the debt or the mortgage. and determining what the best type of mortgage is for that deal based on our strategy of ownership. And then second, I also source the JV equity, the joint venture equity. Usually it's from an institutional provider, so an institutional fund or a private equity firm, and they'll usually provide 50 to 90% of the required equity. So there's typically $2 to $10 million remaining or required to acquire that deal after the joint venture partner has said, okay, I'm going to contribute X amount to this deal. So I will also go out to a list of high net worth individuals or family offices and pitch the deal to them and syndicate the remaining required equity for that deal and that opportunity. I'm raising capital constantly for deals or for the fund. And I also pitch in as far as the acquisition process, basically helping the acquisition team determine whether or not, potential deals are worth pursuing or not. After they've already processed the whole due diligence on a new opportunity, they'll usually bring me in at the end and say, hey, what are your thoughts on this? How do you think we could best capitalize it? And then based on how we could best capitalize it, is the deal still worthwhile to pursue, right? Because you could have a nice piece of real estate, but if the debt is not attractive, it could ruin the opportunity.
What are your metrics for pitching to an investor? It sounds to me that you're really just offering a solid deal. It doesn't sound like you're saying, hey, you're going to get 20%, 20 cap on this, which I hear a lot.
I will say, Kate, so we underwrite and pursue an 18 to a 20 IRR, internal rate of return. For those of you wondering what an IRR is, you could also Google it. Take me about, well, I could probably explain what an IRR is pretty quickly. An IRR is a forecast of the returns, the average return an individual is going to earn off the investment in the deal. And it basically tells you if I'm going to earn a 20 IRR on a $100,000 investment, it means that, and I held that investment for 5 years. When that investment sells, if I earned a 20 IRR, it was as if I earned 20% of my money each year for those 5 years. So that's what we typically target for new acquisitions. And then an average yield or cash on cash, meaning that's what the investor earns on a per annum basis during the ownership period, of 6 to 8%. And on deals we've taken full cycle, meaning from purchase to sale, we've had an average IRR of 36%.
That's amazing.
Yeah. So, and to date, we've done 1.2 billion of total capitalization. We're about to acquire a 36th deal and a little over 12,000 units.
Awesome. Like you said in the beginning, you really love the hunt, right? Finding not only, you have to find it, but then you've got to get it all the way through. I think sometimes it can sound so simple, right? Find a good deal, make 30% of your money, but there's a lot that goes into it.
Oh yeah, big time. Big time.
Can you tell us a little more about your team and how you structure getting it from that point A to point Z?
Sure. So we'll find a deal. Let's just say one of the markets we really like and everyone else likes is Atlanta. And the suburban markets around Atlanta. So we'll find a deal through a broker network. And let's just say it's a $30 million deal with 250 units. And it's a 2000 vintage opportunity. And the current seller has renovated 50% of the units. They've marked to market or increased the rents on those 50% of the units, but the other 50% are still what's called classic, original quality units, and those still need to be renovated. And you can't raise the rents on those classic units because they're not renovated, right?
Right.
So we'll acquire that deal. We'll have what's called a CapEx budget. CapEx stands for capital expenditure, or renovation budget is a fancy term for renovation budget, to renovate the other 50% of the units. We usually have to also install or add amenities to the property or spruce up the existing amenities. What are those amenities? Could be a fitness center, a rentable clubhouse, a dog park, playground, sports court, things like that. Things that make the tenants want to live there and justify increasing the rents. We don't bank on growth in the market. We don't bank on rents going up by 10% next year. What we bank on is the asset we're looking at charges $1,500 a month for 2 bedrooms, and the next door neighbor, who's one of our comparative properties, is charging $1,800. So there's a $300 a month premium we could capture. How do we capture that? Well, we capture it through the strategic renovations that I just described to you. So once we buy the deal, then our asset managers begin to execute on the renovation process and renovate the units. And then on new leases, when tenants move out or existing tenants want to re-sign the lease, we'll renovate those units, and then we'll increase the rents by that, for example, $300. Once we've done that across the whole rent roll, all of a sudden, our income at the property, our net income, in some instances is 1.5 times or even 2 times what it was when we purchased it. And then we'll sell. And when we sell, because we've increased the income to such an extent, the value usually goes up substantially. And then we and all of our investors make nice money off of it.
That's kind of the interesting. I think multifamily can really hedge against market downturns because you're basing it on the net. Really, what is the operating cost to operate it? What's the cost of what is the revenue that it comes in minus the cost to operate? And where can you make that fatter? And how it's interesting because what you're describing can be done on a single unit, a 4-unit property. It's the same concept, right?
Exactly. Yep.
You're
Exactly.
on a bigger scale.
Yep.
You're providing the expertise and the knowledge and the team to execute it on a bigger level, helping investors who have a high net worth want to put their money somewhere that's going to get them a pretty good guaranteed return. Seems like a pretty easy sell, right?
Yeah, spot on. You raise a good point. I will say, a very common conversation I have with high net worth individuals who find us through our website or who we're introduced to will tell us that they themselves own a small portfolio of rental properties, and they're tired of owning that portfolio because they have to answer whatever, get a call at 11 p.m., the water heater broke and needs to be replaced, or whatever it is.
Passive until you're doing what you're doing.
Exactly. So a lot of those investors, what they do is they sell their portfolio and then they find an owner operator like us who's doing it full time, and then they passively invest and they find that they get the same returns that they would have gotten owning their own portfolio doing all the work, but now they're getting that same return passively. So that's the value that we bring to the investors.
That's great. And I love that. And I love what you said, that you like to do this work because you believe in it. And I think it's really easy to believe in something where the math is, it's like, it really adds up. It makes sense, but not to discount how hard the work is. What you're doing is not just putting it in a spreadsheet and spitting it out. You're dealing with people, construction, timelines, budgets, changing economies,
Legal, political, all that. Yeah.
That's right.
It's a lot.
Yeah. Right. So tell us, what are you looking at next? We like to kind of finish the segment off with, what are you working on now? What are you looking for? How specifically, how can people connect with you if they're interested in learning more?
Yes. So we've tailored our website to make it really easy for new potential investors or clients or contacts to reach for us. So www.colonyhillscapital.com. And then there's so many calls to action on the website where people can.
What a great website, I have to say.
Oh, thank you.
Simple. I was able to look through the deals. I love that you have the ones that are open, the ones that are closed. So you can kind of see, what did you just miss out on? What are you working on now? It's very simple. I really like it. So
thank you. Yeah, I appreciate that. And then as far as what we're working on right now is, I mentioned we have our third fund that's open. That's a co-GP investment strategy. So that's a longer conversation of what that means. But basically, we're targeting a 20 to 25% net IRR for fund investors, which is very juicy. And then we also have a deal under contract that I just mentioned in Mount Laurel, New Jersey, which we're raising about $7 million for. So if any investors prefer a direct investment versus a fund, we have that as well.
Very cool. Yeah, we should have you on again. We can go once you've maybe got that one closed. You can talk about how that went and go a little bit deeper into this realm of real estate, because my favorite part of doing these interviews is talking to people about real estate. We go through the same kind of questions, but everyone is in a different niche, a different market, a different type of client, and killing it and doing great.
Yeah. There's plenty of places to specialize and to make money in real estate.
That's right. There's a lot of money out there. There's a lot of real estate out there. There's a lot of deals. Real estate never stops. That was something my mentor told me when I first started. He said, real estate, the market will go like this, but real estate will not stop. So you've got to, if you can learn how to ride the wave, specialize, become an asset yourself. And then people that have money who want to invest, they'll find you and you can help put those deals together, which is the fun part.
Yeah, that's very well said. I agree with everything you just said. I'd add also knowing how to pivot, like we already talked about, right? Pivot with the market. There's always a way to make money in real estate, but you can't keep doing the same thing and expect the same results, because it's a cycle. So you have to know you have to be able to be courageous and know how to change things up if you need to. So
not get too cocky either, right? When everything was on the up and up and during the pandemic, and lenders were just saying, yes, take my money. And that's why I think so many people thought it's going to crash, similar to 2008, because there was that same fervor going on.
Yeah.
We didn't experience a real estate market crash in the sense of property values, but we did experience that crash in terms of interest rates and the valuation.
Yeah, that's right.
And so a little bit of a higher level type of crash that I'm sure kicked out quite a bit of people out of the real estate game.
Oh yeah.
But if you were to pivot and stay, you're now primed for this next wave of real estate, this 2024, whatever it can be. I think if you can make it through what we just went through, feels like we can make it through anything, especially if you've got the right metrics and principles in place.
100%. Yep. Absolutely agree.
Well,
yeah, good quotes, Kate.
Oh, thank you.
Yeah.
I appreciate you so much coming on the show, and we will have all your contact information and the website link in our show notes. And we really enjoyed having you on today.
Thank you very much. Pleasure to be here.
You're welcome. So this is the Real Estate Podcast, From Failures to Fortunes, and I'm your host, Kate Berry. We'll see you next time.
Thank you for joining us on another episode of Real Estate Investing Failures to Fortunes podcast. If you enjoyed today's stories and insights, don't forget to subscribe, rate, and leave a review. Your feedback means the world to us. Remember, your journey in real estate is a marathon, not a sprint. Embrace the failures, learn from them, and turn them into your stepping stones to success. I'm Kate Berry, and until next time, keep hustling, stay inspired, and keep turning those failures into fortunes. Happy investing.